Have you ever wondered why an exchange-traded fund, also known as an ETF, almost always trades at the right price, even with millions of people buying and selling it every day? It's not luck. Behind the scenes, there's a powerful mechanism constantly keeping the price in line. And once you understand it, ETFs become a lot more interesting. At a high level, an ETF is just a basket of assets, like stocks or bonds. But here's the key question. How does the market price of the ETF stay so close to the actual value of that basket? The answer is something called the creation and redemption mechanism. At the center of this system is a special type of institution called an Authorized Participant, or AP. These are large financial institutions, like big banks, that have the ability to create or remove ETF shares. They act as a bridge between the ETF itself and the underlying assets it holds, and they're driven by one thing: profit opportunities. Let's start with what happens when demand for an ETF increases. More buyers implies price starts going up. Here's what the AP does. 1. It buys the actual underlying assets, the stocks or bonds in the ETF. 2. It delivers those assets to the ETF. 3. In exchange, it receives new ETF shares. 4. It then sells those shares on the market. This process is called creation. And importantly, it happens in kind, meaning assets are exchanged directly, not cash. Now let's reverse the situation. If investors start selling heavily, the ETF price may drop. The AP steps in again. 1. It buys ETF shares from the market. 2. It returns them to the ETF. 3. Receives the underlying assets in exchange. 4. Those ETF shares are then removed from circulation. This is called redemption. Now here's the most important part. Why do APs do this? Because they can make money whenever there's a mismatch between the ETF price and the value of its underlying assets. If the ETF is too expensive, AP buys the underlying assets cheaply, creates ETF shares, sells them at a higher price. If the ETF is too cheap, AP buys ETF shares at a discount, redeems them for the underlying assets, sells those at a higher value. This is called arbitrage, and it constantly pushes the ETF price back toward its true value. This continuous arbitrage is what keeps ETFs trading very close to their net asset value, or NAV. In other words, the price stays aligned because professionals are constantly correcting any gap. There's also an important side benefit. This structure makes ETFs generally tax efficient. Why? Because when investors leave the fund, the ETF doesn't need to sell assets for cash. It simply transfers the assets to the AP. Since there's no forced sale inside the fund, it typically avoids triggering capital gains. So the next time you buy an ETF, remember, behind that simple trade, there's a sophisticated system, creating and destroying shares, aligning prices, and keeping everything in balance, all happening quietly in the background.